First section we'll be covering is the market, including latest house prices, HMO demand, and the state of home ownership and the current rental market and climate. In the finance section we'll be covering new portals and strategies and methods to raise finance, including crowdfunding, buy-to-let regulations, recycling of property deposits, joint ventures, private money lending, the repercussions of events in Cyprus, funding for lending and new mortgage rates. In the marketing section, we'll talk about direct-to-vendor marketing and the new regulations and changes, guerrilla marketing and undercover ways that people are finding properties, the confidence within the estate agencies and how they view the prices at the moment and if there are still good property investments to be had from estate agents, and distressed sales. In the strategy section, we'll be covering profit centres, including packaging and selling and trading deals, private investors, pub conversions, multi-let without the sweat and rent to rent, and how to pick the right strategy for you. And then in the final new regulations section, we'll be talking about council tax developments, housing benefit movements, universal credit, the Green Deal, bedroom tax, and office to residential conversion.
Both transaction levels, transaction volumes, and prices within the marketplace are up around 10% on this time last year. Transaction volumes within the marketplace and property prices are both up significantly, around 5 to 10% on this time last year in many areas of the country. HMO demand continues to increase, with the number of renters, especially at the low end, increasing as people can't afford to buy. Home ownership continues to decline, especially in London, with the increase in foreign buyers coming into that marketplace. This is also due to a shortage of mortgages and a reduction in the number of people able to meet the lender's income and general criteria. Because of the number of renters in the marketplace and rental demand increasing generally, rental prices continue to rise. Indeed, LSL estimate that over the last year, rental prices have increased by around 3.3%. In London, the increase is over 6% annually.
There's been a significant rise in private finance, with lending more difficult and banks tightening their criteria. Crowdfunding sites and other non-bank finance lending portals have emerged and grown.
The proposal to regulate buy-to-let mortgage finance within the European Mortgage Directive has been dropped. This is very good news for private property investors.
Because of the difficulty in gaining mortgages and raising finance from traditional institutions, there's been a continued rise in joint venturing, private finance, a significant rise in family borrowing. This is also a result of very high bridging fees. Many property investors are in fact recycling profits and becoming money lenders themselves, earning as much as 2.25% per month, adding this strategy to their buy-to-let or HMO or other property investing strategies. The events in Cyprus have shaken through to the UK, and many people are reticent now to leave their money in the bank, worrying what might happen next and what might filter through Europe. This is creating an unusually high flow of money into property investment through sophisticated and non-sophisticated investors, VCs, business angels, private investors, but also family members, friends, entrepreneurs, and business opportunity seekers are all now far more worried leaving their money in the bank and looking to invest in property both passively and actively.
The Funding for Lending scheme, which is a government-backed initiative which brings money to lenders wanting to lend at higher loan to values, is having a strong effect on buy-to-let mortgage rates in that it's reducing them significantly. Birmingham Midshires have also relaxed some of their mortgage criteria. On buy-to-let properties, they're happy for landlords to rent to students, housing benefit tenants, and also tenants benefiting from diplomatic immunity. They're also now willing to offer loans on properties with a maximum of 5 occupants. The mortgage works have also reduced some of their lending criteria. On buy-to-let mortgages, they now allow landlords to let to tenants on housing benefit. The Manchester Building Society have introduced 2 new 25-year fixed rate buy-to-let mortgage products at 5.74% and 5.99%, the longest that I have ever seen in this marketplace. Capital allowances continue to be a boon for property investors, although sideways loss relief, which is the loss relief you're allowed to use on income streams not connected to property, has now a limit of £50,000 per annum.
In property marketing and the acquisition of property investments, there's been a big recent resurgence of personal direct-to-vendor marketing. There are many vendors who don't want to deal with estate agents, and the recent increase in confidence in the market from the estate agents has forced many vendors not to sell their properties through the estate agencies. These vendors become more distressed and desperate because they have no medium in which to sell their properties, and ending up waiting longer and selling their properties much more below the market value. You may have seen in your local town or city bandit boards, personally written, handwritten signs, vans with signage on the sides and the front and the back, and stickers and lamppost signs. And all of this guerrilla marketing is aimed at going directly to the vendor where they're more distressed. As a result, these strategies are creating discount purchases for savvy, opportunistic investors. The estate agents are more confident in the market since the turn of the year, where prices have strengthened in most areas, not just London. Because of this confidence, they've been rejecting lower offers that may have been accepted last year. Professional property investors now, and especially new investors into the marketplace, need to be able to show proof that you've done deals, proof that you have finance. Relationships with estate agents need to be nurtured more. And I believe come summertime, this confidence will reduce and things will change. There may be a price stagnation later on in the year, and if you're an opportunistic entrepreneurial property investor, you'll want to build those relationships now so that you'll receive those deals in 3 to 6 months' time. The latest profit center strategies in the current marketplace are deal packaging, sourcing and trading. There are even more investors this year than last year sourcing deals for other people, trading properties, flipping properties, becoming deal packagers, because there are more and more people coming into the market who are more flippant with their cash, more people who want a return on their money but don't know how to buy properties and are worried with the current banking situation. There are more and more new property investors setting up their own property businesses with the low barriers to entry, and they're able to attract customers much more easily than they were pre-credit crunch. Corporate letting, rent to rent and multi-let without the sweat strategy is continuing to rise and become more fashionable. The wider market and general landlords still aren't exposed to this strategy, so it's a good time for entrepreneurial, opportunistic property investors to get in with little deposits and minimal outlay to grow your cash flowing portfolio. But like with sale and rent back and lease options, over time your general landlords will become aware of this strategy and will start to implement them themselves on their own properties. So I believe you need to get into this strategy quickly.
Pubs continue to be great value. I know of at least 3 pubs locally that can be bought for under £250,000. This represents a very low price per square foot. That gives a great opportunity for HMO conversion or for flat conversion projects, creating really good income and a great profit.
Despite these many contrarian opportunistic strategies in this marketplace, many new investors are experiencing overload, overwhelm and confusion. It's very important not to get more information, but less information from trusted sources. It's also very important not to take on too many strategies at once. 70% of your work-related time should be focused on your one main strategy. 20% of your work-related time should be focused on your secondary strategy and 10% on a future strategy. 5 strategies at once is too many strategies in this marketplace, and only one strategy has the problem that it could become redundant in a very fast changing market.
There continues to be a lot of controversy surrounding overseas investments. I would recommend caution if you are investing in a market that you don't live in or understand completely.
Regulations are always changing, and it seems since the last State of the Property Market address, there have been many regulation changes.
One of those regulation changes regards council tax. On empty properties, council tax is now payable after 1 month rather than 6 as previous. Benefit rates are continuing to reduce, along with those that are eligible to claim them. From the spring, office conversions to residential will not require planning permission in many areas of the country. From classes B1 to C3, you'll not be required to make a major application. There are major benefits here in that over 14 units you won't have the normal affordable housing or 9 in London. The Section 106 and the Community Infrastructure Levy won't usually apply, and it makes the whole process of converting an office into flats much simpler, much cheaper, and critically, much more certain.
Due to these new regulation changes, significant drops in the prices of commercial property, and the ever-changing financial climate and difficulty in gaining finance, many previously inexperienced commercial investors are moving to commercial property. Many investors who are just doing small single-let or HMO residential investments are now taking on larger commercial projects. The upside benefit of commercial projects are obviously significant, and it might take the same amount of time or similar amounts of time to do a big commercial deal with much larger income as it might for a smaller residential. This is bringing many more opportunities for new and intermediate level investors, but there is a caution because the market is very different with commercial property as it is to residential, and you'll need to make sure that you start small and build your way up to the bigger conversions and office space developments.
Universal credit, which is a major change to the benefit system, will come in shortly. There will be an overall household cap of £26,000 a year, which a household will be able to claim. Many tenants are going to receive many hundreds of pounds a year less in benefits and may no longer be able to afford their current rental arrangements. Changes are likely to have significant impact upon tenants living in high rent areas. Landlords are going to see an increase in the instance of rental arrears as well. From April 2013, benefit tenants are likely to have their entitlement cut if the council decides that their home is too big for their needs. The so-called bedroom tax, which is an under-occupancy rule, is going to have a major impact both on tenants and on the landlords that are renting to them.
The repercussions of universal credit and new benefit regulations are serious for property investors. Many years ago, we were buying many properties locally, and the local housing allowance rates were significant enough to make that a more viable investment proposition, giving you higher cash flow and yields. This is changing, and many investors are now moving towards more professional tenants than housing benefit tenants. We believe we'll see many investors flock from LHA benefit tenants to professional tenants, and this will have a big impact on the market, and we also believe that this may impact upon these new regulations with potential U-turns in the future.
The Green Deal went live in January. This is the government's attempt to make the housing stock in the United Kingdom much more energy efficient. Free boilers, free windows, amongst other energy saving measures, are being rolled out under this scheme, and many believe that landlords will see great benefit.
So what does all this mean to you, and what does this mean to new and professional property investors? Increasing prices has made it slightly more difficult to buy deals through the estate agency, but you shouldn't give up. You should continue to build your relationships, because this will change throughout the year. The dramatic freefall in home ownership means rentals will continue to increase, and that's great news for property investors, with increased competition for your rentals, which is likely to strengthen rents and increase cash flows. With private rental rates rising, this is only a good thing for professional property investors, and yields could continue to grow despite being high already. The recent events in Cyprus and the ensuing media frenzy around that has put the fear into many institutions, tightening their criteria. But it's had the opposite effect to private investors, joint venture partners, business angels, venture capitalists, entrepreneurs, friends and family members, crowdfunding. There's been a significant influx of this private finance into the marketplace, which is great news for property investors, especially those who can't raise finance. This money is coming into the market fast and more flippantly than usual. Despite this reaction, some buy-to-let specific lenders have relaxed their criteria, giving more confidence to property investors who've been in the market many years. The significant increase in direct-to-vendor marketing has created a larger market in that sector. Despite larger competition in your area for direct-to-vendor sales, this is a great opportunity if estate agents are being resistant. Deal packaging, trading, selling deals, flipping deals, building your own property business and selling your deals that you don't keep in your portfolio for profit are on the rise strategically, and many investors coming into the marketplace who are new and inexperienced, or JV partners or private lenders, are looking to you to source these deals because they don't have the experience. Corporate letting and rent-to-rent continues to be a strong strategy, especially for people with limited finance. Be careful not to be overwhelmed with too many strategies. Reduce the amount of information you take in, but increase it from singular, more trusted sources. Don't take on more than 3 strategies at any one time, and make sure you use the 70-20-10 rule. With the increased controversy over overseas property sales and investments, steer clear of anything too far from your local area. If you're an experienced property investor, a move into the commercial market could mean you achieve a lot more income and capital in less of your time expended. We hope you've enjoyed the State of the Property Market address, and please do download the accompanying manifesto.